Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking all about cash. As I'm sure you've noticed, interest rates have gone up just a little bit, and it's been a while since we talked about your emergency fund and where to park excess cash. How big should your emergency fund be? Should you keep it in a checking account or a savings account or maybe a CD? How do all these things fit together, and what's a decent bank these days for parking high-yield savings? We talk about all this in detail in today's episode, and I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today's show is going to be all about cash. It's been a little while since we've covered cash on the show, and with interest rates bouncing around on us, the yield curve is inverted. We talked about that a couple weeks ago. The options for storing your cash and commanding the best yield that you can in a safe, hopefully FDIC covered environment have simply changed a little bit. And so in today's episode, I'd like to talk a little bit about the methodology that I think makes the most sense for how much cash you need. So of your assets, if you have cash in the bank, what's an appropriate amount? What's too much cash? What's not enough cash? How do you figure all this out? And once you do you have your cash in the right account? Maybe you have an account at, U.S. Bank or Bank of America or something like that. Is that the right place to store it? Well, this is a question that comes up so frequently, I felt compelled to cover it on the show. And especially because the environment is changing a little bit. The Fed is raising interest rates at the short end of the yield curve. It just means that we're able to get a little bit more yield out of our cash savings, which is especially important with inflation where it is right now. So this warrants further conversation. And where I think probably makes the most sense to start is just a framework to use for figuring out how much cash you should have in the first place. A lot of practically all financial planners at some point will comment on the concept of an emergency fund. It's really, really important that before we lock any cash up in a retirement account or in any kind of investment that we might want to remain in for a long period of time to maximize our returns, that we have an ample amount of cash readily available to us if we need it. And some people will call this an emergency fund. Some people will call this liquidity reserve, or whatever. You can use whatever term you want. The idea is that it's really important to have a little bit of cash laying around for a rainy day so that you don't have to dip into your investments at an inconvenient time. And not coincidentally, the stuff that might come up that could require you to dip into your emergency fund often coincides with bad economies and down markets, right? We're trying to, with our investments, we really want to buy low and sell high. And so that means that when things are not going so well, when the market's been down 20% maybe after a year like 2022, that's not the period when we want to pull from our investments, sell securities, take the cash out to, put a new roof on the house or something like that. We want to sell securities to raise the cash to replace the roof when values are a little bit higher. And keeping an adequate emergency fund is what just simply gives you the flexibility to wait around for a more strategic opportunity. That's the whole idea. Not to mention the fact that if you have to dip into your investments, you might have capital gains tax that you're responsible for. You might have to dip into a retirement account, which is not ideal for people who are not really formally retired and in that phase of their lives. And so having enough cash is just really important for a number of different reasons. Now, the method that we really like to use here at the firm with regard to how much cash should you really keep around? I think it should be a function of your living expenses. A lot of people will say that as soon as you have 3 months worth of living expenses in the bank, that's a sufficient amount of cash. Once you have that in the bank, then you can go off and use your extra money to do other things. I'm a proponent of having a little bit more cash than that. And that's partially because we work mostly with business owners who have a little bit more uh, variability in their earnings month to month and year to year. Partially, it's because those business owners often have bigger needs for cash when the stuff comes up. Either way, I'm usually a fan of somewhere between 6 and 12 months worth of cash sitting in the bank ready for you if you ever need it. Maybe the water heater breaks, it's not covered by your homeowner's policy. You need to pull a couple $1,000 of cash. Maybe you need to replace a car all of a sudden. Maybe all that coincides with a day that you get laid off or that we hit a tough period in the economy and your business profits are down. Right? We don't want to have to dip into our long-term investments and that are meant to be locked up and compounding for us at an inconvenient time when they're down. So the way that we do this is go back to your budget. What does it look like on a monthly basis? How much money do you have coming in? How much do you have going out? What are your discretionary and non-discretionary expenses look like? Take a typical month, multiply it by somewhere between 6 and 12, depending on the circumstances. So if you're someone who has monthly expenses consisting of mortgage payment, insurance, taxes, groceries, entertainment, eating out, utilities, gas, add up all your expenses in a typical month. Let's say it totals $10,000. If you're someone who's on the younger end of the spectrum, who doesn't have other mouths to feed, who are relying on your income with a really predictable amount of cash coming in every single month that you're really, really confident in, then you probably need less cash on the shorter end of the spectrum, maybe more like 6 months. But if you're someone who's getting a little closer to retirement, maybe you have other people in the household who depend on your income, maybe you have more variability in your income month to month because you own a business, or maybe you're entering a volatile period with your work or sales commissions or whatever it is. That's a pretty good recipe for storing more cash and being on the higher end of that spectrum. Call it 12 months, right? So part of this is comfort, part of it is your time horizon, part of it is your risk tolerance, part of it are just the facts and circumstances around how important that cash coming into the household is to you and the rest of the family. Figure out where you fall on that spectrum, multiply your monthly expenses by whatever that number is. That should be your emergency fund. So I use a really round number here and call it 10 months worth of expenses just to keep things simple. If you've got $10,000 of monthly expenses, you want to keep 10 months worth of expenses in the bank, then you should target $100,000. Now, we talked a little bit about financial order of operations. This is maybe 4 to 6 weeks ago. Go back and listen to that episode if you haven't already, because for planning purposes, for business owners, when you start to have more cash coming in than you need on a monthly basis, you start to think about planning for your future. When should you invest? How should all the stuff be organized? There's an order of operations that I think makes a whole lot of sense. You need to have a little bit of business or have a little cash in your business. You need to have a little bit of cash in the bank account, but you don't necessarily need to get to that full $100,000 on day one, right? There's a priority list that we need to think about here first. And that probably means keeping, a month's worth of operating expenses in your business and cash ready for you. It probably means keeping like 1 month's worth of expenses in a checking account ready for you. It means hitting all the appropriate insurance policies, and then it means coming back to that full emergency fund or $100,000 afterward. So that's the idea. We want to make sure we have enough cash sitting around for a rainy day before we do other stuff with it. You don't want to take all your savings account and go pick up another rental property and draw your cash all the way down. It's a little bit too risky. This doesn't mean that you can't dip into the emergency fund temporarily for purchases or other things. It's there for a reason, but we don't want to use that cash frivolously. So let's say you're someone who has $150,000 in cash sitting in the bank as your emergency fund. You go through this exercise and figure out, well, hey, I only need $100,000 worth of cash. What do I do with the extra 50? Well, that's when we can do other stuff. We can deploy that into tax-advantaged retirement accounts. You can put that back into your business for reinvestment. You can start thinking about that rental property or that other type of asset or alternative investment. Perhaps you can invest it in a taxable account. You can pay down debt. There's a lot of things that you can do with it. And one of the considerations ought to be what your debt profile looks like, what interest rate you're paying on that debt is, and what you expect to earn out of one of these potential alternatives. Cap rate is one way that we evaluate real estate investments, and it's similar to the return that an investor would get. If you have a cap rate of 4%, but you're paying 5% on your mortgage, probably does on the mortgage on your existing house, it probably doesn't make sense to go invest in a new property that's only going to return 4% when you can pay down a mortgage that's charging you 5% per year. So that should be a consideration. Now, the question that always comes up, really the crux of what I wanted to cover today is, well, what do you do with that $100,000? We've been saving. Where does it sit? Does it sit in checking? Does it sit in a savings account? What's the right type of bank account for us? Could I put it in a CD maybe? The general rule of thumb, it needs to be liquid and available to us at all times, which excludes CDs for the most part. We cannot have any gates against redemptions. We need to be able to access it whenever we want. We need to make sure it's insured by the federal government, which means FDIC coverage in a bank account. And we want to earn the highest yield that we possibly can. So that doesn't mean go buy a bunch of junk bonds, because those are not insured by the FDIC. They're not safe. They're not totally safe. It also doesn't mean keep it all in the checking account, because in the checking account, you're not going to yield nearly as much as you would in a high yield savings account. So if you're someone who has maybe a couple different bank accounts, one of them is at, let's say you have a checking and a savings account at your local credit union. What we want to do is stick 1 month's worth of living expenses in the checking account that's not going to earn very much, but is also going to be there for available cash so that you don't ever risk overdrawing the account. You can set your credit card payments each month on autopilot, so it's just drawn from that account. Everything else ought to be in a savings account that earns more. Savings accounts will sometimes have restrictions surrounding how many transactions you can have per month. That's okay, right? We're not expecting that you're going to need to tap into your emergency fund more than periodically. And that's so it's okay to have a limit on the number of transactions. And if you really needed it, you can draw it all out in one transaction into your checking account. That's really not that much of an issue. What is more relevant these days, with inflation being high and interest rates going up to compete against that, is the rate that you're getting on those savings. And the fact that you might have a savings account does not necessarily mean that you're getting an adequate rate of interest on it. We had for a while accounts, personal and business accounts at Wells Fargo. And I am not a fan of Wells Fargo, to go on the record with that. All the stuff that they've done, opening accounts in the name of their customers without their knowledge to boost their own bonus numbers, that's wrong. They've paid fines for that, and beyond that, we've had a really poor experience there. But it's hard to change bank accounts. So we do have a couple of accounts at Wells Fargo. They have hardly anything in them, but the rate that a big national bank like Wells Fargo or U.S. Bank or Bank of America or Chase pays on savings is exceptionally low. Those banks, their model is typically to use their brand presence and the comfort level you have banking with a big institution like that and not pay as great of interest rates. An alternative to that, which we've talked a little bit about in the past, but I want to remind everyone of, is what's called an online bank, which may not have a local branch, a physical branch office that you can walk into and talk to someone at, but also doesn't have that operating cost of paying rent and having to deal with all that. They work more nationally and electronically, and because they don't have those operating costs, they're able to pass through a far greater savings rate to their investors. And specifically, I'm talking about Ally and Capital One. Capital One has a little bit more of a physical presence than Ally does, but if Bank of America is going to pay you, I would say at best less than 1% per year on your savings, which is probably in the ballpark right now, Ally, and I just looked this up to prepare for the podcast today, is paying 3.3% in a high yield savings account. Okay, there's no fees. There's a limit to 5 transactions per month, but like we talked about, that's okay. You probably don't need to access your emergency fund frequently enough for that to be an issue, right? And if you do, just bring it all back into checking and forego a month's worth of interest. It's not that big of a deal. Capital One is another option. And typically when I look at this stuff, Capital One and Ally are the two leaders because they have, again, lower operating costs. They're able to pass through more of these savings rates to account holders, and they really compete neck and neck. It's rare that I'll see a better rate at one bank than another that stays that way for more than a week. If one of them moves, the next one will move right there with them. One thing I will say here is that I have heard rumors and stories that Ally is far better at raising rates on existing accounts than Capital One is. And I have direct experience with this with several of our clients. They open an account at Ally, they put cash in there for their emergency fund to sit, and then Ally will subsequently raise the rate on their existing balances as the interest rate environment changes. That's happened, and Ally is really good about passing those increases through to existing account holders. I've heard stories from Capital One account holders recently who opened an account a couple of years ago, a high yield savings account, then interest rates go up. They expect Capital One to raise the rate on their existing account, but the 0.75% that they were getting 2 years ago never changes. Yet they're offering 3.3%. It's advertised on the front page of their website to new account holders. So they call up the service line. They say, hey, what gives? Why am I not getting 3.3%? They say, well, you were in an old account. That account's not eligible for 3.3%. You have to open this new account and move the money over, which is complete nonsense and an excuse for the bank not to pass through the savings to their customers. I get it. They're trying to maximize their own profits, but suffice it to say that the rates that Ally and Capital One pay on pay to new depositors these days, very, very similar. But anecdotally, I've seen Capital One not pass through future increases to account holders, but Ally be very, very forthcoming and willing to do that. Now, rest assured that when it goes the other way, interest rates come down, all banks will reduce the rate on your savings account that you get as soon as they possibly can because they're trying to preserve their margins. So all that to say, I'm a big fan of Ally. The only restriction that's really halfway relevant is you're typically limited to 5 transactions per month out of a savings account. Again, it's really not that big of a deal. Now, let's talk about some other options. High yield savings accounts are not the only mechanism here. There are other things that you can use. You can go buy a CD, which, it's not the end of the world. You could theoretically ladder them out. Maybe if you have, simple example, a 3-month emergency fund, which again for business owners is not quite enough, but let's use it as an example. Maybe you keep a third of that in a savings account readily available to you. You take another third and buy a 30-day CD, and then you take the remaining third and buy a 60-day CD. It's called laddering them out. That way, if business cash dries up for whatever reason, you have the first month's of living expenses in the bank ready for you to pull out whenever you need it. The second month's living expenses will mature in the CD after the first month's available cash has been depleted. And then after the second month's has been depleted, the second CD, the third month's worth of cash, matures and becomes available to you. That's reasonable. Sometimes big expenses that require more than 1 month's worth of cash come up, which is a reasonable reason not to stretch this out too far. But I wanted to mention it. At Ally, you can buy I think it's a 90-day CD, maybe a 60 or 90-day CD, and it may be the same rate for 4.15% right now. So it's worth thinking about because that's a lot better than the 3.3% that you're getting on your savings. High yield savings account available to you all the time, 3.3%. You give Ally the money, but you lock it up for 60 days. Now all of a sudden they're going to pay you 4.15%. That's a lot better. Now, there are other options beyond that. And if you're going to go the CD route, two of them that you should consider are what are called brokered CDs or T-bills directly. This is the best rate that you can get in the market. Banks operate and set interest rates that you get on your savings based on the federal funds rate that's set by the Federal Reserve. And basically that's the rate at which banks operate between one another. You can also buy T-bills directly from the federal government. You can do that through a brokerage account. You may even be able to do that through Federal Direct, which is where you buy I-bonds, but you can definitely do it through a brokerage account. And right now, 90-day T-bills are paying 4.35%. So if you're really trying to maximize your savings rate on cash, and you're absolutely sure that you can lock that up for 90 days, lock the cash up for 90 days, that's probably the best way to go. You stick the cash in a brokerage account, you buy a 90-day T-bill. T-bills there are a lot of them out there on the market. Any major broker can help you buy one. It probably has inventory to sell you one, but it is definitely different than buying a stock. So this strategy here is not for the layperson. It's for someone comfortable transacting and is okay with the nuance here. But if that's you, that's not a bad way to go, is buy a 90-day T-bill with a portion of it, a portion of your cash. If the stock market crashes before the 90 days is up, when the T-bill matures, the value of the T-bill isn't really going to change. If interest rates change, it may impact the value of the T-bill by just a little bit, just like any other bond. It still means that you're going to get your money back plus 4.35% annualized interest after the 90 days when the maturity comes. But it means that if you have to sell it between when you buy it and the maturity, then the value might be a little bit lower. So it's something to consider, but you be sure that you're comfortable with those ramifications. Now, brokered CDs are another option. I mentioned the Ally CD, or you can look at CD rates at your local bank and compare them, of course. Any CD or any bank really can offer a CD, and most of them do. Money you give to the bank in the form of a CD is FDIC insured, and it's called a retail CD. You walk into the bank or you go to the website, you buy it directly from the bank. They're selling it to you being a retail customer. CDs are a really important financing mechanism for banks. It's a way that they bring cash into the bank for their own operations. But selling them through that retail channel is not the only way that they do it. They also sell them to other banks and brokerage firms. They sell these CDs. And a brokered CD is one that goes through that brokerage network that you buy on the secondary market. So, for example, let's say you walk into your Bank of America, they are going to show you a CD rate, let's say a 3-month CD rate of 2%. which is probably in the ballpark, I would guess. I haven't looked it up. Well, you might be able to go onto your brokerage account and with the help of your broker, access the brokered CD network and buy the exact same Bank of America FDIC covered brokered CD, which pays maybe 2.5% or 2.75% or 3% over the next 90 days. The rates are better because the distribution network is far more efficient and streamlined on behalf of the bank. It's the exact same reason that if you put $1 million into a Vanguard mutual fund, you get a higher share class and pay a lower expense ratio than if you put $10,000 into a Vanguard mutual fund. You can't command the same fee structure because it's less efficient for Vanguard to deal with a whole bunch of different $10,000 investors than it is fewer $1 million investors. Same thing goes for CDs. You go through the network. There's this pipe that's created through the network that the bank can utilize over and over and over again, as opposed to handling each individual retail retail CD purchaser that walks into the bank. So at any rate, that's another option. Both T-bills and brokered CDs, you would put cash. Again, we're talking about your emergency fund dollars, not your portfolio investments. If you have emergency fund that you want to go this route with, you can put it in your brokerage account. You can look at buying a brokered CD or a T-bill directly from the U.S. government. The CD will be FDIC insured. And the only difference is that when you log into your brokerage account, it does have just a tiny bit of duration risk. If interest rates change, let's say you put $10,000 into one of these things and then interest rates change. Well, if you log into your account the next day, the value of that 90-day T-bill might be a little higher or lower than $10,000. You're still going to get the 10 grand back when the 90 days are up, but if you have to sell it to someone else before then, you might get a different amount than the $10,000. That's what that means. So the final point I want to make here is that remember our rules for emergency fund cash needs to be readily available to us at all times. We want to command the best yield that we possibly can, and we want to make sure it's insured by the federal government. Well, CDs and T-bills are not as liquid as high-yield savings accounts. You have to transact if you want your cash back. You have to sell it on the open market if you want your cash back before the time's up. And if you have a retail CD, you have to put it back to the bank, and they're going to charge you a penalty for that. So it's not quite as liquid. It's still doable if you're comfortable laddering it out as we described, but it's not quite as liquid. T-bills do not have FDIC coverage. Brokered CDs do. So if you buy a brokered CD, let's say that's issued by Bank of America, and then Bank of America goes out of business, the Federal Deposit Insurance Corporation is going to come in and give you your money back. It's FDIC insured. Okay. The FDIC itself is a federally sponsored it's a government organization. So T-bills don't have FDIC coverage because they don't need it. T-bills are loans directly from the federal government, and if they default on them, it's going to be a huge, huge issue in the global markets, and therefore it's mostly irrelevant that there's no FDIC coverage on a T-bill. So there's the landscape these days. Rates are starting to go up. It is important, again, to evaluate the rate you're getting on your cash, because as soon as you have your emergency fund intact, now you've got a decision to make. With extra cash, do you pay down debt? Do you invest it? Do you hike your retirement account contributions? How do all these things fit together? And because you can get 3.3% in a high yield account at Ally or 4.3% in a T-bill, the calculus between, well, what do you do with that extra cash? Do I pay down debt? Do I invest it? Do I add to the emergency fund? It's all changing a little bit. And so it's important to make sure that your savings are working for you. If you have a Wells Fargo or a Bank of America savings account that you haven't paid attention to, you just kind of put money in, now is the time to take a look at it and just make sure you understand what rate you're getting on your cash. Because if it's at a big bank like that and you haven't looked at it recently, I can guarantee you're getting far less than 3.3% on your savings. If it's $10,000, $20,000, that's not that big of a deal. If it's $175,000, yeah, it's probably worth looking at because you can squeeze a couple $1,000s extra a year in interest by scrutinizing it a little bit more. Okay, that's it for today. We didn't talk about money market funds. Those are an option. You can buy government-sponsored money market funds. Typically, the rate you get there is going to be lower than what you get through a CD. Usually, it's comparable with high-yield savings rates. By and large, high-yield savings accounts are a little bit easier to handle because you don't have to transact with a mutual fund manager to get your money out. You can just withdraw it whenever you want. It takes one step out of the equation, and the rates are comparable. But there are circumstances when that might be a little bit easier for you using a money market fund. So, topic for a future day. Hope this was helpful. Talk to everybody again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.